This is Jay Martin.
Now, talk to your point about most financial advisors not having a firm grasp of the implications of these geopolitical threads as they're unraveling, because I imagine a lot of my viewers, have their money managed by some of these financial advisors. So what's the fallout? What's the risk of having, I don't know, young, inexperienced, or just ignorance is bliss, financial advisor managing your wealth and not understanding how Europe may shift, how the BRIC currency may evolve? What's at risk here?
So I can get more hate email, because every time I talk about this subject, I get it. And I know that from financial people is,
bring it on.
I have argued that a good percentage of financial advisors, and again, I'm only speaking in the US, that's the only thing I have experience with.
All right.
I have coined them the don't worry, be happy crowd. I have stated that they could be tossed off our Empire State Building and all the way down. They'd all say the same thing. Hey, so far, so good. Okay. and there's a particular network down here, a financial network, which is really their home base. It's always good. It's always great. Dare you say anything otherwise? Okay. That's what almost 2/3 of financial advisors have only been in the business since the last financial crisis. And so I argued, and that was the reason why I turned so bearish last fall, is that you learned how to drive on a one-way street. Listen, I don't blame them. I'm not saying that they purposely know that they're bad and stupid and they're doing this on purpose and robbing people. No, they were weaned and taught basically a car goes one way. You step on the gas pedal and it goes. And by the way, if you happen to hit a bump, there's this tow truck driver called the Fed. They come along, they get a little quick fix, and you're back running down the road again. Yeah. And that's what they've been used to. And the public has grown accustomed to that as well. Individual investors cannot be guiltless. They are, after all, there's more information now, Jay, to teach oneself and to learn than when I started in the business. So you can't just say that, oh, I just totally trusted that person. I doubt they go to a doctor without seeking some, knowing how good they were or some experience, or they just pick a lawyer out of the yellow pages. So don't throw it all on your financial advisor. But the problem we had, Jay, is a year, 18 months ago, we had 21, 22-year-old internet sensations that were gurus that were born out of the pandemic, who really's only most difficult problem they had up to that point in their life was algebra class just a few years ago in high school. And here they were, and people were following them as if, they were a messiah. And so I really think, and I know you've been around long enough, and I know your dad would agree with me, experience is normally a good asset. Sometimes it's not, but more times than not, the more experience you have. The difficulty is in finances, sometimes you don't get twice a bat. You only get one a bat. And we've seen that recently with a lot of the younger people who rushed into the cryptocurrencies and saw literally a couple $1 trillion lost by people who can ill afford. The stories you're hearing of the losses, the actual people who took the losses, are not 65, 70-year-old men like me who were worth millions. A lot of it were young people who sounded like a quick way to the riches, and they went in it all. So there's a lot of pain still to be out there. And like I just said, it doesn't mean because someone's young, you don't deal with them, but keep in mind their limited experience may hurt you in a much bigger game now that's being played that really wasn't taken into account a couple of years ago. Geopolitics, we've seen it now because of COVID, and we've seen it because of this energy crisis. And Jay, you were around enough to remember when just 10 or 15 years ago, Wall Street sold globalization is the key to everything. The whole world needs to go global. And the net result was we now suffer a lot of issues because of that.
Yeah. And we all suffer from recency bias to some degree, right? Financial advisors, investors, the most, right? We frequently, and this is something, I guess, as you said, you have to learn it the hard way. I have at least twice. You confuse a bull market with your own savvy, right? And that's a painful lesson to learn. But okay, but you're right. It's the every day the market goes up is affirmation that the next day it will do the same. So it's almost realistic to expect that status quo, right?
So a good point to make on this, Jay, I think it'd be worth time. So when I entered the business in the early 1980s, the stock market for 20 or 25 years was stuck between 700 and 1,000 on the Dow. In fact, if there was a famous Business Week article that was a front page of the Business Week that said equities are dead. And people were petrified. Interest rates had just been 20%. Inflation was 15, 20%. Howard Ruff had the war room. And it was hard to find somebody that was bullish. And this young man out of Georgia named Robert Prechter Jr. came out and said, hey, I got this basically new technical analysis, and the Dow's going to 3,700. And people looked at him and said, Dow 3,700? For 30 years, we've been stuck between 700. It was inconceivable. And even in the few years early when it started to go, people said, that's not. And then the crash came in 87. They said, see, I told you, I knew this guy was crazy. And we went down a little bit, but 5 years later, we were way past 3,700. But it took several years for people to see the change and wanted to stay in the old way. Well, now for almost 40 years, we had a bull market clearly in bonds that never stopped. And we had basically a bull market in stocks that were interrupted with some very serious but rather short-term downdrafts or declines or swoons, whatever you want to call it, but not long enough for people to even have to start thinking about, I got to reallocate or rethink a self. Yeah. And so the first time we've come down now from these highs last year, especially we saw stocks that were 100 or 200 trading at 20 or 30, and 6 months later, it's not surprising that they rebounded. Okay, that shouldn't be a surprise to everybody. The question is always this. I got it at Cambridge shows. I got it no matter where I was. And I think people will always ask this and say this. Hey, you guys that give out advice in the days that I used to, you always tell us when to buy. You don't tell us when to sell. And I always had a simple answer, Jay. Some people thought it was too simplistic, but I really think it's the bow. And I always say, listen, can you today, forgetting every reason you had gone into it or whatever, could you take the money you now have in that group, sector, stock, whatever, and first buy it today? And Jay, as soon as they start to pause and go, I don't, that's your first signal, because that's all that's going to matter is the future. And the hardest thing for someone to say, whether they're an advisor or an investor, and hubris and pride get in the way, is what Fonzie couldn't say several decades ago. I was wrong. Okay. And like you just admitted, I was wrong more than 2 times, Jay, in 38 years. All right. And cost me millions of dollars. And when I look back at it, it's because I wasn't willing to change and take that attitude when I first buy it now. Okay. Yes. So I think that's a great way and a good test for everybody. So no matter what has happened up until now, if today was just starting today, would you make the same or hold the same asset allocation that you have now?